Good morning, Daniel.
Good morning, Dan.
How was your trip across the plains?
It was my fourth time in about a calendar year. So I think I'm excited to say I'm done doing it for the foreseeable future, but it's also a unique privilege to be able to see so many different states, I'd say.
Sure. All right, you're not going to moonlight as a trucker then?
I don't think it's in the cards.
Fair enough. Well, what shall we talk about today?
We have a good conversation today. We're going to discuss ESG, or socially responsible investing, Bitcoin and blockchain, and whether AI will replace financial planners in any way.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, so environmental, sustainable governance investing, ESG, social responsible investing, SRI. My least favorite topic, Bitcoin blockchain stuff, and then whether AI is going to replace advisors, which I will say AI is also rapidly becoming my other least favorite subject. And I promise I'm not a Luddite. I promise. It's really just I'm tired of talking about it.
Well, today we're going to talk about it.
You got me. You got me in the room here. So, all right, have at it. Start us off. What do we want to talk about first?
I want to start with ESG, socially responsible investing. It's something I read about a lot, but if we're being honest, it's not something I think we discuss with clients too frequently. It's been in the financial planning landscape for a while and part of some conversations, but I wanted to discuss the merit of it and whether it's something we should be implementing and discussing with families.
Sure. Well, I mean, first and foremost, let's just round out that definition a little bit. So, the basic idea behind something like ESG or SRI investing is that we have values or beliefs or politics or morals, all sorts of things. And so, from that frame, we then think about our investments as an extension of ourselves and sort of in the sense where, like, if you were a pacifist, you would not engage in combat sports. The idea here is that if you are really interested in the particular ethics or morals or values or real world impact of what your investments might do or what the companies you invest in might do, you may choose to invest in specific companies or to omit certain companies or certain types of investments from your portfolio to better accomplish your moral or ethical or political worldview.
All right. And is there a difference between ESG and socially responsible investing, or are those just synonymous?
They're technically different. They came about in different times. ESG is sort of SRI 2.0. You could find an investment nerd out there who could really pick at the differences there. But I think for anybody listening, generally speaking, these are sort of the same thing. They've just been sort of the terms of art at different times in history. And ESG is sort of the current version. SRI was more in vogue in like the 90s and the early 2000s.
Okay. So, how do we approach this with clients? Is it something that there's merit to, or something we really just want to have a discussion about and weigh the pros and cons of?
Well, so generally speaking, if a client doesn't come to me with a specific set of values, goals, morals, etc., where they say, like, I'll give you an example. If you are Muslim, if you are a believer in Islam, then if you are doing halal investing, you are not supposed to receive interest. It is considered a sinful act to charge others interest and to receive interest. And so there are banks and investment products and things like that that cater to that religious belief. And so if somebody comes to us with something like that belief and says, like, I do not want to receive interest, I do not want to invest in bonds or anything that does that, it's against my religious beliefs, okay, then that's a basis for it. And we can construct a portfolio that accomplishes those goals. But if you don't come to me with strongly held religious, political, moral or ethical beliefs, I'm not going to nudge you to do those things, because from a risk return standpoint, what over concentrating in certain assets or reducing your diversification to exclude certain assets does is functionally not necessarily adjust your risk. It doesn't adjust your return expectations necessarily, but it does increase your risk because you are increasing your concentration. You are reducing your diversification, and so without an actual request from a client to have their beliefs be a factor in their portfolio, I'm not going to prompt that discussion because I don't want to introduce unnecessary risk for no reason.
Oh, that's a really good point. I didn't even consider is just the fact that investing in ESG funds or socially responsible investing probably increases your concentration within certain sectors or avoids others. In your experience, is it more about avoiding harmful or things you're against, or just supporting and things that might have a more positive impact?
So there's really different lenses that this gets approached through, and in particular, there's different lenses for the individual investors, and there's different lenses for the institutional investors who run the products, the ESG ETFs or mutual funds or that sort of thing. For individuals or for the individual client, I think it often is going to be typically more of a focus on exclusion than selection or inclusion. Exclusion would be something like you have a nonprofit endowment and your nonprofit exists to fight lung cancer. Well, probably then pretty reasonable that your endowment is not going to want to invest in Philip Morris or other tobacco companies. And so it's going to make sense for you to exclude that from your portfolio. You're introducing risk, but you're also not supporting the thing you are actively trying to fight against that creates the sort of harm in the world that you're trying to fight against. So then it's just a look, yes, we're taking on risk, but we're also advancing our mission by doing this. For some individual investors, and when I say this, you've got to be a really big of an individual investor. ESG investing might get away from things like funds. You might actually just say, I want to change the policy at this company. I'm a multimillionaire. I'm a billionaire. I am going to buy substantial amounts of stock in this particular company in order to attempt to influence the board or get onto the board, such that then I can have a voice at the table for the decisions of this company. Now, that's not an option that's available to the everyday person, but that is sort of an activist view of it. When you get into the institutional side, this is where I think it gets to be a little bit more problematic. The vast majority of companies that say that they do ESG investing in their products or in their funds, they're not doing it with any politics, ethics, or morals in mind. They're just doing it as a tool of analysis. So in the same way that they look at the balance sheet, the cash flow, the profit and loss, all those various things for companies, and scrutinize their returns and their growth and their profit margins and all of that, they're just scrutinizing these ESG factors, their environmental impact, their social impact, their governance policies as risk factors and valuation factors. So there's a lot of companies or fund companies that are doing that. And then there's others that actually take an activist role where they try to get boards to do certain things. And then finally, there's ones that do it more as an exclusion screen. It's like, hey, we're really concerned with the environment. We're going to exclude a lot of energy companies or manufacturing companies. So it depends on the thematics for the institutions and sort of what the actual strategy and application of ESG is. On the individual level, for most people, it's just avoiding things that they don't believe in. And in rare cases, it's about advocacy or activism.
Did you say there that there's an issue on the institutional side in the way that they analyze, per se?
Well, so not so much in the way they analyze it, so much as there's a very, I'll say, self-interested, cynical approach to ESG in the institutional product side. So, for example, there are a lot of companies out there that have a range of ESG products. They'll have something like a generic ESG product, like this is just our ESG US large cap fund. And then they might have something like an ESG product. Well, here, I'll even give you really specific examples. So take that first one I gave. BlackRock has a fund like that. It's like 10 basis points, but it's essentially the S&P 500 with ESG. And then you have a different one from them, and it's about climate change, like specifically about like rising sea levels and investing in companies that are not impacting climate in such a way that it affects global temperatures. And that one costs, I think, like 40 basis points. And when you look at these, and you also then compare them to just BlackRock's standard S&P 500 index fund, and you look under the hood, they're all essentially the same fund. Like the top 10 holdings are essentially the same with like one difference in the sea change version. The proportions are essentially the same. And so you look at that and go, okay, I could buy an S&P 500 fund that has no particular omissions or exclusions. I could buy a ESG fund that is essentially just an S&P 500 index fund, but it costs 3 times as much. Or I could buy this, sea change environmental impact global warming fund, and it costs, 30 times as much. And it's also still almost the exact same fund because the company is just using ESG as a marketing tool to attract investor dollars to a higher margin product. Because if you weren't an ESG investor, you would probably just go with that S&P 500 fund and you wouldn't mind. But if you don't have the skill set or the knowledge or the ability to do the due diligence to actually look at what is inside the product, you might say like, well, I care about global warming, so I'm going to go buy the sea change one. And on an investment level, I'm going to have almost no impact on anything, but I'm going to get to pay 30 times as much for the privilege.
Oh, that's really interesting. That for the most part, there's a considerable amount of overlap. So if somebody comes to us or is just interested in having this conversation, is this something you'll bring up, or will you provide pushback if it's something they want to invest in? I guess how do you weigh, their politics and beliefs against some of the things that might be a hindrance to their ability to build wealth?
This is where we get into sort of a conversation about like the president cycle, right? Like all the data suggests that if you only invest when Democrats are in office or only invest when Republicans are in office, you won't get half the performance of the market. You'll get like 1/10 the performance of the market because those protracted non-investment periods of 4 or 8 years at a time where you're not in the market when quote unquote the other side is in office really robs you of a lot of compounding and value. So it makes sense to stay invested across the line. So when a client has something like that, where they just say like, I'm really worried about Trump being in office, or I'm really worried about, the Supreme Court being a particular way, or I'm really worried that there's Democrats who run the Colorado legislature, like whatever it is, I'm always like, yeah, like that's the thing that will change over time. That's probably not a reason to make big changes. But when they say like, look, my spouse died in an accident driving a Ford car, and there was a builder's defect in the Ford, and we sued them, and yada yada. I never want to invest in Ford. I never want to own Ford stock. I hate that company. Okay, like that's your belief. I'm going to help you accomplish that. So push pull tends to be about a question of whether the intended investment is going to have any actual impact or whether it's just a reflection of values. That's what I tend to pay attention to. So we have clients, for example, we run a nonprofit endowment for a nonprofit that really supports migrant populations. And so for them, it was very important that they didn't invest in military industrial companies that, provide arms to the conflict areas that they have people that they serve from. They didn't want to invest in private prisons because, again, there's sort of a prison industrial complex in the United States. And unfortunately, migrant populations are often the de facto profit center for those types of businesses. So they wanted to exclude certain things. That's fair enough. That makes sense. We have other clients who wanted to invest specifically in companies with women in leadership. Well, there are products that mirror to investment companies that have a certain number or proportion of women on the boards or in CEO seats or just C-suite roles in general. So like there's certain things we can cater to there, but what we're often very cautious with is this a thing you want to bet your entire life savings on? Or is this just a small policy preference that you'd like to show a little support for by investing in a certain way with a particular tranche? Most people tend to fall into that latter category. There are definitely people out there who will never invest in something and they will die on that hill. And that's obviously a more important conversation to be had. But for a lot of people, it's often just sort of, and I want to be careful here because I don't want to sound like it's not important, but for a lot of people, it's this sort of shrugging indifference, like, yeah, I just really wish my money didn't invest in companies that do stuff that I don't really like. And when you kind of push them on that, a lot of them just don't have a strong enough belief or specific set of beliefs that can really be implemented in that sense.
No, that's really fair. I think asking the question if it's something you want to bet your entire life savings on or something you'd want to parse a tranche out for and maybe just invest a little differently in a certain way with a small amount of money is really important. It's really also interesting to me how, some of these funds maybe don't have the transparency or aren't as different from just a regular fund as maybe I might have thought, or someone who doesn't do this for a living and just assumes that it's a fund investing in things not pertaining to oil, how different that really might be from a regular fund. And I think that's really interesting and something that people should probably consider.
Well, and to be clear here, I don't want anybody listening to this to hear me say, like I don't think it's a big deal or I don't think it's very common or whatever the case is, and think to themselves like, oh, Dan doesn't want us to do this, Dan doesn't support us doing this, or conversely, like if he doesn't think it's a big deal, I shouldn't think it's a big deal. Your beliefs are your beliefs, your values are your values. I'm not here to tell you otherwise. What I want to emphasize is that your stock portfolio is perhaps not the optimal mechanism for affecting world change in the way you want to. So just keep that in mind. Sort of in the hopes and prayers sort of way. A lot of ESG investing is sort of the hopes and prayers version of trying to make an impact on something like the tobacco industry or the oil and energy industries, that sort of thing. If you want to really make an impact on those things, you're much better off donating time and money. And it's okay to do both, right? You can say, I'm not going to invest in oil companies, and I'm also going to donate to environmental nonprofits, and I'm going to volunteer my time and expertise to those. Terrific. That's awesome. Please live your values, live your ethos. But just by extension from that, be mindful that a lot of things that happen in the ESG world are performative, and that big institutions are more than happy to take your money to help you sort of pat yourself on the back and feel performative when in fact you may not be really making any material difference if you are not approaching it in the right way.
Well said. So here's another topic for you. One you might have more strong passions about, which is Bitcoin and blockchain technology. Before we even get into opinions or just the merits or downfalls of blockchain or Bitcoin, I think it's important to just distinguish between the two. I think we use the term synonymously, but there is a little bit of a difference, I believe.
Yeah, I mean, blockchain is the underlying technology. Bitcoin is sort of the first tokenized use case for it. I'm going to bet everybody listening to this understands blockchain, so I'm not going to over explain this very much. But very succinctly, blockchain is a technology that allows multiple parties, i.e., hundreds, thousands, millions of different places to have the same distributed tracking system, or what's often called the distributed ledger, where all transactions, all activity, et cetera, related to that blockchain are shared across all of the various places and platforms, which essentially means that there is an enormous massive number of duplicated copies of all the transactions related to that thing, and therefore it's very hard to hack or do fraudulent activity or so on and so forth. That's the basic technology. And so there's a lot of real world applications where you can think about like security, banking, asset tracking, titles, all sorts of stuff where it's like, wow, wouldn't the world be great if there was like a truly unified, massive, unhackable, uncrackable way of tracking all of these various things. That's the basic principle behind the technology. You can give an entire class. There are entire classes, there are entire books really digging into the actual technical details under that, but that's the basic conversation for blockchain. Bitcoin, again, is just sort of the first tokenized use case for that, where somebody invented a blockchain, somebody created a token that could be used on that blockchain, and that's the history. And obviously, we all know what Bitcoin is today.
Excellent. So let's stay on blockchain for a second. You mentioned a lot of things there that piqued my interest, especially in our industry. It's the ability to have a clean record and the ability to have things transfer very securely. Do you see a future or ability for blockchain technology to be used in something like financial services?
I mean, blockchain is functionally already being used in financial services. This is where you get into sort of the world of crypto exchanges, or now there's this conversation about having a strategic Bitcoin reserve. You've had companies where literally their entire balance sheet is Bitcoin, specifically to create proxies for investing in Bitcoin. And there's all sorts of interesting use cases for it. I think there are a number of seriously problematic limitations to the technology, which I'm going to bet will be solved over time, right? Just as all things go, the first version isn't very good. The 1000th version is pretty great. So I think it's a constantly iterating, growing thing where probably as time goes on, more and more stuff we use and do will live on something like a blockchain for security reasons. But in practice today, when we think about like the investment tokenization world, there are a lot of problems there.
Okay, what are some of those issues?
Well, I mean, let's look at Bitcoin as just the classic example. So, Bitcoin, if we kind of just lay it out on the table and say, like, what is the purpose or point of Bitcoin? It is a decentralized currency that, as a unit of exchange, same as a dollar, same as a Canadian dollar, same as a British pound, a euro, right? It's a currency. that nobody prints, nobody controls, nobody has direct, power over, and therefore, like all other currencies, it's worth what people think it's worth, what people are willing to exchange for it. And so that's the use case, and you can have all conversation about not letting the government control currency, or a libertarian ideal that people should not be tracked or traced by third party institutions, yada yada. But just to get into the literal and tangible problems of something like Bitcoin can perform 7 transactions a second. Now, that's a lot of transactions for you and for me, right? We're not doing 7 transactions a second. But think about something like the MasterCard network or the Visa network, which are probably handling several million transactions a second across the globe, and are doing so in a much more energy efficient way. So a single Bitcoin transaction takes about the energy consumption of 2 months of utility bills in the average American home. So think about that. Think about all the TV you watch, the time you spend on your computer, your clocks clicking away on the wall, your stove, your oven, your microwave, right? Your cell phone charger. Think about all the electricity you use if you live in, let's say, a 3-bed, 2-bath house in suburbia, or if you live in an apartment, like double it, triple it, whatever. But think about that. Think about 2 months of that. Think about how much money it costs you in your utility bills, right? It's probably 150, $200 a month. So think about, $300 to $500 of energy costs for one transaction, right? And if Bitcoin came with a price tag that said, hey, every time you buy or sell something with Bitcoin, it's going to cost you $400 or $500 per transaction, you'd never use it. No way. But because of how Bitcoin is operated through mining and so on, the energy consumption of Bitcoin is currently equivalent to the energy consumption of the country of Argentina. It's the 27th most energy consuming country in the world. So it's not number one. It's not the United States, not China, but it's the 27th most energy consuming country. It is the consumption of an entire country for money, right? And again, like Visa, MasterCard, Amex, our banking system, they all use electricity and power and energy. They don't even remotely scratch the surface of how many or how much energy is utilized by Bitcoin alone. And that's one cryptocurrency, let alone if we get into the enormous universe of other tokens and ICOs and NFTs and all the various other things that exist on blockchain. Blockchain's fundamental problem is that it is a very inefficient solution to the problems that it purportedly solves. And so that's sort of the fundamental issue from a real world impact thing. And then there's a whole separate conversation, and maybe we'll have it here in a second, about just the investment characteristics of something like cryptocurrency.
That's insane, the transaction speed and energy it takes for Bitcoin compared to something like a Amex or MasterCard or Visa. I didn't really even consider that or know anything about that. And is that something you think would, as they iterate on the blockchain technology, would continue to improve? Or, I mean, it's been around for a decade plus at this point, and the fact that it's only gotten that far and still consumes that much energy is pretty crazy.
Well, two things to that. First and foremost, Bitcoin's almost 20 years old. Like, think about that for a second, right? It's almost as old as you, Daniel. Like, you were in grade school when Bitcoin was created. It took a long time for it to get traction and actually like get out there into the world in a serious way, but like it's been around for a minute. And something like Bitcoin specifically is not going to be improved because Bitcoin itself is what it is. You have then things like apps where it's like, okay, well, we can create a secondary ledger where like you and I can transact in Bitcoin not on the blockchain, but one day we'll like settle up and the net of transfers will happen, and that will be one of the 7 transactions a second on the blockchain. But until that, like Bitcoin is always going to consume this much energy unless people stop doing Bitcoin mining and stop making Bitcoin function, because that's what all the mining purportedly generally provides, is essentially the consumption for this ledger. Because the challenge is every single person who gets on the blockchain is adding to that energy bill in perpetuity. So like that, Bitcoin's never going to be improved unless people just stop using it, stop doing it. Now, newer tokens, newer cryptocurrencies are much more energy efficient, much faster. Again, like it's being iterated on, it's being made better. But I come back to sort of the what problem are we solving question here, and it's supposed to be essentially to have money that's not controlled by the government. And I can hear a good argument for that, but I gotta say, I'm kind of shrugging my shoulders and going like, yeah, is it perfect that the United States has the reserve currency of the world and the dollar is, the petrodollar and all the various things that it gets used as the reserve currency in? Like, is there a better thing to that? Sure. Is it worth the cost and the damage and the environmental consumption and all of this? I don't know. I'm not sure. I find myself dubious on that one.
Yeah, well, even in addition to that, as a currency itself, it's considerably more volatile than the US dollar. If I have one Bitcoin today and that buys me a bagel, if tomorrow that Bitcoin is worth half as much, now I get nearly half the bagel, uh, which is another reason I struggle to conceptualize it as a currency with stable value. Uh, Is that something that you consider and think about as well?
I mean, certainly, and that's sort of one of the interesting things. People talk about Bitcoin as being a hedge against hyperinflation, but Bitcoin itself, because of its nature as an investment asset, functionally hyperinflates itself all the time and hyperdeflates itself all the time due to its volatile nature. And there's lots of anecdotes, right? The people who paid like 15,000 Bitcoin for a pizza one time, like there's a whole bunch of stories like that. There's a guy who apparently had something like 10,000 Bitcoin on a hard drive, and it's in a landfill somewhere. And like they're literally just like to this day trying to dig up that landfill, trying to find that one hard drive because 10,000 Bitcoin times the current price is an insane amount of money. Like there's all these sort of externalities here where you go, like it's just not a good solution. And again, you can then say, well, there's a better cryptocurrency now. It's Ether or it's Solana or all these other alternatives. Or somebody's going to invent a perfect cryptocurrency at some point that solves for all these issues, and maybe they will. But I still just return to like this current use case where I go like it's not a stable investment asset, it's not a good currency, it's bad for the environment. Like what are we doing here? What really is being improved here? And also, why is anybody interested in it? Because we say like you can solve all these problems, but ostensibly cryptocurrency's two biggest use cases have been essentially criminal activity, money laundering, paying for drugs, prostitution, sex trafficking, etc. And on the other end, it's just been a highly speculative, ultra high risk investment asset class. And some people have made a ton of money from it, and also a ton of people have been absolutely scalped by it. And that's sort of the problem. Is it is a world of winners and losers. There's a lot more losers than there are winners in it. Because it's highly decentralized, deregulated, and so on. And functionally, again, I just look at it and they say, is the value it's producing in whatever value you define it as outweighing its costs? And I just generally don't see the case for it today.
Is there an argument to potentially be made it can be more of a collectible, like baseball cards or coins, or maybe a commodity like an alternative to gold or silver?
I think that's where you get into like the NFT world a little bit more, right? Where you have like NFTs of art or NFTs of videos or NFTs of songs and whatnot. Because then there's something to that. Although even NFTs are weird because if I buy, let's say, an NFT of a song, I don't own the song. I just own a non fungible token that represents that song. So there's a whole bunch of things there. One of the most interesting arguments or conversations I've ever heard on this is from a couple of years ago at this point, but it was essentially like a crypto advocate and a crypto skeptic having a conversation. The advocate's talking about like you could put like your house on the blockchain. You could have like a title to your home on the blockchain, and then you could borrow against the title on your house on the blockchain, and people could give you like Bitcoin, and you could use that to renovate your house in the real world. And you have all these contracts and they're self-executing on the blockchain, so like it's a perfect system. And then the skeptic just sort of said like, well, what happens if somebody doesn't pay? Like somebody borrows the money and then says like, and now I'm not going to pay you back. Well, like you'd have to take them to court. Okay, then like how is that an improvement over the basic system of deeds and banks and borrowing that we already have today if you still need a legal third party intermediary called the government to enforce this contract that you just said 5 seconds ago is a self-executing perfect system? It's like that's sort of the issue where there's definitely things where you could definitely like if somebody wants to go buy 1/1000th of a Bitcoin just to say they have it, like knock yourself out. But in the sense that like it's a collectible, it's valuable, it's somehow like meaningful, meh. There's a lot of people who find it super meaningful, but unlike let's say water or coffee or wheat or oil, if cryptocurrency vanished off the face of the earth today and we'd never had that idea and it never happened, the world is not any worse for it.
Okay, so it sounds like not something we'll be recommending to clients in the foreseeable future here.
There's all sorts of things where we could like put 1% of a portfolio into a cryptocurrency ETF or something and have it just be a super high risk, ultra volatile asset in our portfolios. And the trick is, during certain time periods, it would probably juice our returns really nicely, and during other periods, it would just crater and ruin our returns. And so I come back to like the what is the point conversation. If the point is to make money, it's going to make a lot of money in certain periods, and it's going to lose a lot of money in certain periods. And if I'm thinking about investing as a long term activity, I don't know what that hyper volatile asset is actually doing for us.
Okay, thanks for the information. So, lastly, here, I wanted to talk about AI. I did a presentation in financial literacy recently for a local high school, and one of the main topics that kids wanted to talk about and students was AI and where they saw AI within the landscape of financial planning and if they saw it taking over our profession. Uh, and it's one of these questions, I think, and topics that's continued to come up more and more recently, as you said, starting to become your second least favorite topic right behind cryptocurrency. So I wanted to discuss it with you and see how you felt, and if at all, where you saw AI taking some place within financial planning, if at all.
I mean, we're definitely already using AI in financial planning, and there's specific applications, tools, et cetera, that are built entirely on an AI chassis. I think AI is going to be a useful tool in financial planning, but no, I don't think it's going to replace financial planners. At least not at like the caliber or the degree that we do it. It replace some like call center models or some like super high volume models where instead of paying 10 basis points in your portfolio at a company like Betterment and getting to talk to a person in a call center, instead you'll get to talk to a really strong like large language model. I can see certain things like that happening, but no. And I say that because not because I have like sort of an ego, like, ha, I'm irreplaceable. I say that because my real world experience over the past decade as a financial planner is that the numbers are never compelling enough. Because if the numbers were compelling enough, we would have the most compliant, wealthy, well off clients on earth. Like every financial planner would have like just billionaires and multimillionaires as clients because you can use tools, you can use financial planning software, you can get AI to tell you the perfect way to execute this, that, the other, and then people won't do it. Or they'll do it inefficiently or they'll do it ineffectively. And you might then hypothesize, like, well, yeah, but like if people are doing it for themselves, they'll take it and they'll just like execute it. You can even have an AI that'll just do it for them. Like, yes, but then people will still make suboptimal decisions based on personal preferences, biases, concerns, fears, whatever. And that's where the human touch really becomes valuable, right? I was talking to Emily on the podcast last week, and we brought up that like a big part of our job is just telling our clients on a regular basis because of market things, right? The analogy we use is don't shoot yourself in the face. And then the clients keep coming back and saying, well, somebody on TV said I should do that. Like, no, don't do that. AI is an interesting thing because AI could give you the exact right answer to a problem or a question or an issue that you have in finance. But are you going to do it? Are you going to trust it? And do you have the knowledge and capacity to identify whether it is or isn't hallucinating? Are you willing to risk losing all of your life savings on that bet? Are you willing to risk going to jail on that bet? So like there's a lot of issues there where fundamentally AI is a super powerful tool, but there's this outstanding risk that it's not human and it's not perfect. And people tend to not trust machines as well as they might trust other people that they've built a relationship of trust with.
I think the relationship aspect is such an important part of it too. Financial planning does involve a great deal of technical knowledge and knowing the nuances of certain rules, regulations, and intricacies of investments. And, over time, I'm sure AI can help assist in the accuracy of planners being able to articulate that information to clients. But, there's a lot of emotional things that happen too. People have deaths of people near and dear to them. People become injured, disabled, or have difficult conversations. And I really struggle to see a scenario in which language models can have those very difficult conversations and not be human and interact with people and simply empathize in a way that replaces such an integral part of our job that frankly is not on our website or on any resume.
Yeah, I'm reminded of this scene in the third season of Westworld. Spoilers, everybody. Where Aaron Paul's character has applied for a job and he gets a phone call, and this warm guy, sounding guy, is on the other line and says, "Hey, I want to give you a call. Your interview was great. Your resume was terrific. I'm sorry we did go with another candidate, but I just wanted to give you a call and let you know." And he's really grateful. But I was like, "Is there anything that that I could have done to be a better candidate. And he's like, it really just came down to a pretty tight race and whatnot. He's like, is there anybody I could talk to? Like, I really think I'm a great candidate. And then like there's a pause, and suddenly the guy goes, hey, I just need to let I'm just a bot model, and I'm not really able to answer those questions the way you'd like me to, but I'm happy to send a message to somebody who can. Like, and so he thought he was talking to a person because the voice is so warm and convincing, and I'm sure it was just like a voice actor in reality. But on the other side of that, at some point it just broke down and said like, sorry, I can't give you the emotional validation you need right now. I say that, but again, I remember what I said up top. I think AI is already in use. I know it's already in use, and it's going to stay in use because I can think of a ton of great non-client facing applications for AI that would make our lives that much easier and our work that much better. It's just that the technology is still on its way to getting there.
Okay, I'd love to talk about that. Where do you see it becoming a useful application in our careers?
So, just to give the public listening to this some idea, probably the most common utilization of AI right now is in note taking. It's having an AI bot listen to your conversation or your meeting on Zoom or whatever it is and sum up all the ideas and thoughts and suggestions and writing up action items, takeaways, and just providing them in a nice, pretty report. Some fancy versions even will like create tasks and work items and updates and notifications in tandem with that. And like that's one step in that direction. I think a future iteration version that would be enormously useful would be, let's say, an AI bot that will just take all the data a client provides in a secure location and will collate that and enter that into financial planning software so that we've saved the manual task entry part of that. Or an AI that helps ideate certain planning solutions in the context of planning software where it says like, hey, all the data's in here. Automatically, the AI's identified 17 different like optimizations that could be done in this client's world. And you could say, well, that could be a client-facing application or a public-facing application too. Sure, it could. That's still where you get into the is it the right choice for me? Like, here's the technically correct, the numbers are right answer. Does it work for me based on my goals, my objectives, etc.? And so that's where I think we'll see more and more tools like that, more optimization, more time saving. But I think AI is probably forever on some level going to have a hard time replacing the human element. Because, as has been mentioned before, that tends to actually be the hardest part of the work of financial planning is not getting the numbers right, but getting the right numbers for the right person at the right time and in the right way.
Excellent. Well, it's nice to know we have some level of job security then.
Oh, I have job security. You might be in trouble. You gotta work on them people skills.
Fair enough.
All right. Anything else we want to talk about on the subject of AI?
No, I think that covers it. I really just wanted to know your perspective and how, if at all, it kind of fits into our career. And I think we're kind of on the same page there. There's a lot of human elements to this job that I just don't think a language model will ever be able to replace. Might be a great tool for synthesizing data and helping us apply that data, but that might be where it kind of stops because at a certain point, people want to sit across from a person and be able to have conversations with real people and hear from a real human sometimes.
Yeah, and I'll use another profession just as an example of this. People thought that the advent of personal computers was going to be the undoing of the accounting and bookkeeping profession. Today, there are not enough accountants and bookkeepers to meet the demand for accountants and bookkeepers. And that's not a consequence of the technology. That's just a consequence of lack of interest in those fields, lack of compensation in those fields, et cetera. But that those fields were made enormously more efficient and were able to handle that much more work and serve that many more clients and so on, because keeping something like the ledger up to date was no longer a manual process flipping between pages of an actual physical ledger. It was software, and so it just made that many more accountants, CPAs, et cetera, able to serve that many more people, that many more companies and clients. And consequently then the demand for those services has grown and grown and grown to the point that today, like, it's actually hard to find a good bookkeeper, it's hard to find a good tax preparer, it's hard to find a good accountant. And if you do find one who is good at their job, not just acceptable at their job, they're probably a little bit more expensive than you thought they should be, because all that efficiency did make them more efficient, but it also made them that much more valuable to the marketplace. And so consequently, the trend of time has been that even though you'd think that would have undone it or made them obsolete, it just made them more important.
And comparing that to what we do, the more time that we can spend with families and the less time we can spend doing data entry and some of these tasks AI might be able to replace, the better off everyone will be, because we'll be able to have more conversations with real people and, dive into the work that's really impactful for families even more.
Well, and just to put that in context for the same sort of accountant-like story here, the estimate is that we're going to be 75,000 financial planners short in the United States by 2033, and that we're going to be 100,000 financial planners short of the necessary amount by 2034. So within the next decade, we are going to see the needle tilt further and further and further in, I hate to say, in favor of us as the financial planners from like a business standpoint, and further away in favor of the need for the public. And AI will help bridge some of that gap. It is going to be a big part of that equation. But that's a serious issue. That's part of why we're so passionate about trying to help build financial planners and teach and educate financial planners here. Because if we don't help solve that problem, if our industry doesn't find a way to solve that problem, the public is going to bear the costs.
Well, I guess hearing about that looming demand, I just need to work on my people skills.
Work on them people skills, Daniel. And on that subject, since you already have to work on that, and that's already a discovery of the past week or two here, what else have you learned in the past couple of weeks that you want to share with our audience?
It's actually kind of relating to the third topic here today, which is being able to talk with a human being. So the markets have been pretty much all over the place the last couple of weeks. They've been up, they've been down, sideways, in between. And we like to be proactive and reach out to a lot of the families we work with in advance of them potentially having any cause for concern. And we work with, and we're very grateful to work with a lot of really wonderful people. And in some of those conversations, one of the main themes I got was, hey, we're okay. But even though we're okay and we know we're going to ride this out, we're really happy to hear from you. And just know that you're keeping a pulse on things and thinking about us. And, I'm not sure that's something that can ever be replaced, and really emphasizes just the importance of being a human and thinking about the families you work with and taking care of them.
Absolutely, because nothing matters more. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.